Have you thought about what happens when you one day retire, move on from your business, or pass away? If you're like 65% of Canadian business owners, you likely don't have a plan in place. Without proper succession planning, this could lead to unexpected business disruptions, loss of value, family disruptions, and more. Hi, I'm Gregory Rosdiba, the CEO of Dundas Life. With over a decade of experience in financial services, I've helped hundreds of business owners protect and strengthen their financial plan using life insurance. Whether you're a small business owner or managing a growing company, having a solid plan in place is key to ensuring long-term stability. Today, we're going to cover some crucial topics, including what a buy-sell agreement is and why it matters, how life insurance provides liquidity to keep your business running smoothly, the key legal, tax, and valuation factors you need to consider, and how different types of agreements work for different business structures. But here's something to think about. I'll reveal a case where failing to plan costs the company millions, and how you can avoid the same fate. Stay tuned and make sure your business doesn't fall into the same trap. If you find this video valuable, don't forget to like this video and subscribe to our channel for more expert financial planning insights tailored for business owners. Now let's dive into buy-sell agreements. Buy-sell agreements come in two main types. Let's start with a cross-purchase agreement. Imagine running a business with a partner for 20 years, only to realize their spouse now owns half of it overnight. Without a buy-sell agreement, this scenario can become a reality, leading to uncertainty, conflict, and potential business disruption. In a cross-purchase agreement, each business partner owns a life insurance policy on the other. If a partner passes away, the insurance payout is used to buy out the deceased partner's share, keeping ownership within the company. One of the key advantages of this approach is the surviving partner receives a tax-free death benefit, providing immediate financial support during a critical transition period. Additionally, the cost basis of the purchased shares increases, which helps reduce capital gains tax when those shares are eventually sold. However, cross-purchase agreements become significantly more complex when multiple partners are involved. For example, in a business with 5 partners, a total of 20 life insurance policies would be required. This is where an entity purchase agreement makes more sense. In an entity purchase agreement, the business itself owns and pays for life insurance policies on each partner. If a partner leaves or passes away, the company uses the insurance payout to buy their share, ensuring a smooth transition. However, if not structured correctly, it could lead to tax complications, such as unintended corporate tax liability. The right approach depends on your business size and tax situation, so working with a licensed insurance advisor, like one at Dundas Life, is essential to avoid pitfalls and ensure the best outcome. Why are buy-sell agreements important? One of the key benefits of a buy-sell agreement is that it limits ownership transfers that could potentially harm the company. Without a structured plan, a departing owner's stake may pass on to someone who has no experience, interest, or capabilities to run the business. This can create uncertainty and potential conflicts among remaining owners. A well-structured buy-sell agreement keeps the business running smoothly, even when the unexpected happens. This agreement also reduces financial strain. Instead of forcing the remaining owners to find a large sum of money or to take on debt to buy out a departing partner's share, it provides clear and manageable payment options, such as life insurance or structured payment plans. This ensures a smoother transition and financial stability for the business. Imagine you and a business partner own a thriving local store. If your business partner were to pass away unexpectedly, their family would inherit their share of the business. Picture this. Your partner's family demands control, and you have no legal right to stop them. What's your next move? Without a buy-sell agreement in place, you might find yourself in a difficult position, either struggling to buy them out or facing new, inexperienced ownership that could impact operations. A buy-sell agreement removes this uncertainty, ensuring a seamless transition and protecting the future of the business. Now that we understand the importance of buy-sell agreements, let's explore how life insurance plays an important role in making these agreements financially viable. Without a reliable funding source, executing a buy-sell agreement can be challenging. Life insurance provides a practical solution to this problem. So why use life insurance in a buy-sell agreement? A properly structured life insurance policy ensures that funds are immediately available to execute the buy-sell agreement when a triggering event, mainly a partner's death, occurs. Here's why it's a powerful funding tool. It provides immediate liquidity. Instead of struggling to find funds, life insurance guarantees a payout right after a partner's death, allowing the business to seamlessly transition ownership. It protects cash flow. The business doesn't have to pay out all at once or take loans to buy out a partner, preserving financial stability. It's cost-effective. Compared to buying out a partner with installment payments, life insurance premiums are more predictable and often lower in the long run, making them a practical choice for business continuity planning. Paying premiums annually instead of in installments can lead to significant savings, as monthly installment plans cost about 11% more annually. Overall, life insurance ensures funds are readily available when needed, maintaining business stability and allowing for a smooth transition of ownership. A well-structured buy-sell agreement ensures that if an owner leaves, whether due to retirement, disability, or an unexpected event, there's a clear plan in place. There are a few key factors that make a buy-sell agreement effective: business valuations, tax implications, and a solid legal framework. Let's break them down. Business valuations. One of the most important aspects of a buy-sell agreement is determining the value of the business. After all, you need a fair price if one partner is buying out another. Some businesses choose a fixed price that is agreed upon in advance, while others prefer to have a professional appraisal conducted to assess the company's market value at the time of a buyout. Another approach is to use a formula-based method, which calculates the value based on specific financial metrics. Regardless of the chosen method, regularly updating the valuation is essential. Businesses grow and change over time, and an outdated valuation could lead to unfair buyout prices, disputes, or financial strain. By keeping the valuation up to date, all partners can be confident that they're getting a fair deal when the time comes. Tax implications. Taxes can have a big impact on how much money actually changes hands in a buyout. The structure of a buy-sell agreement determines the tax consequences for all parties involved. In a cross-purchase agreement, business owners take out life insurance policies on each other. When one owner leaves or passes away, the remaining owners use the tax-free insurance payout to buy the departing owner's shares. This approach also has the added benefit of increasing the surviving owner's cost basis, which can help reduce future capital gains taxes. In an entity purchase agreement, the business itself buys life insurance policies on each owner. If the policy isn't structured properly, this payout could be taxable, leading to additional costs for the business. Understanding these tax implications ensures that business owners and their families don't face unnecessary financial burdens when a buyout takes place. Legal framework. A buy-sell agreement is only as good as its legal structure. It needs to clearly define what events will trigger a buyout, such as retirement, disability, or death, and how the buyout will be funded. Some agreements rely on life insurance policies, while others may use company profits or financing. Another important element is establishing a process for resolving disputes in case the owners can't agree on terms. Without these legal safeguards in place, disagreements over valuation, payment terms, and other details could lead to conflict. Working with experienced legal and financial professionals ensures that the agreement complies with all provincial and federal laws. A well-structured agreement provides peace of mind, knowing that everything is legally binding and will hold up if challenged. Now let's take a look at some real-world examples to see how buy-sell agreements work in practice. Family-owned manufacturing companies. Joe and Mike ran $1 million company together until tragedy struck. What happened next changed everything. Joe and Mike, two brothers, co-owned a successful manufacturing business. To protect their company, they set up a cross-purchase agreement with life insurance policies on each other's lives. When Joe unexpectedly passed away, Mike was able to use the insurance proceeds to buy Joe's shares from his family for $2 million. This ensures a smooth transition of ownership and prevented any potential disruption in the business. The agreement allowed Mike to maintain control without the need to involve outside parties or deal with complicated financial arrangements. tech startup with multiple founders. In another case, a tech startup with 5 co-founders implemented an entity purchase agreement to simplify ownership transfer. When one of the founders left to start a new company, the business was able to use the insurance proceeds to buy out the departing partner's stake for $800,000. This avoided financial strain on the business and ensured that the remaining founders maintained control. These real-life cases clearly demonstrate how buy-sell agreements, whether structured as cross-purchase or entity purchase agreements, help maintain stability and prevent operational disruptions, even in the face of unexpected events. Buy-sell agreements, funded by life insurance, are essential for protecting the long-term stability of a business. They provide a clear plan for ownership transitions, ensuring there's no confusion if an owner passes away, becomes disabled, or retires. These agreements also offer financial security by guaranteeing the funds needed to buy out a departing partner's shares. This prevents surviving owners from having to drain cash reserves or take on debt to keep the business running. Finally, they protect against unexpected disruptions. Whether due to a sudden loss or unforeseen event, a well-structured buy-sell agreement ensures the business can continue operating smoothly. Planning ahead gives business owners peace of mind, knowing their company and partners are financially secure. If you're a business owner, now is the time to take action. Don't leave the future of your business to chance. Work with a Dundas Life licensed professional to structure a buy-sell agreement that aligns with your specific needs and goals. Click the link in the description below to schedule a free consultation today. Let us help you design a comprehensive plan that secures the future of your business. Don't forget to subscribe for more insights on business planning and life insurance, and stay informed and prepared. Your business's future is too important to leave to chance. Let's secure it together. Thanks for watching. Remember, at Dundas Life, we make life insurance accessible and empower you with knowledge you need to protect your business.